Alright, guys. Um, Welcome to this YouTube video. In case if you're just watching my YouTube or you're just visiting my YouTube channel for the first time, my name is Daniel DC, and I'm a forex trader, a crypto enthusiast, and a financial trader. That's what I do. I trade the financial markets, ranging from commodities to currencies, metals, and so on and so forth, energy, whatever. Basically, I trade the financial markets. And today, I'm going to be teaching you very powerful chart patterns that you need, or that you are just going to be needing while analyzing the charts as a financial trader. Basically, there are a lot of chart patterns, right? So many chart patterns, so many. I can't continue to list them. Double top, double bottom, ascending triangle, descending triangle, head and shoulder, and so on and so forth. But the thing is, majority of these chart patterns are not just used. You can't just use them anyhow. You only use them when the market is in a certain direction, right? Just like saying you can't use a head and shoulder chart pattern in a bullish market. It's going to be very invalid. But there are three powerful chart patterns that 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 can be used, that you need, right? One of them can be used in any market, be it a bullish market or a bearish market, whichever direction the market is headed, you can use one of these chart patterns. Why the others are used for specific directions of the market. They are just like opposites of each other. Firstly, we're going to be talking about the symmetrical triangle. We have what we call symmetrical triangle. Symmetrical triangle. Then, okay, let's take this here, symmetrical triangles. And okay, symmetrical triangle is just something like this. Here you have something coming from this direction, right? You have another point from this direction, and whatever parts the market breaks out from, whatever the part the market breaks out from, you trade in that direction. This is how the symmetrical triangle works. You trade in that direction. If it breaks out from the downside, you trade in the direction of the downside. So this is how a symmetrical triangle works. Very simple. It forms on the 15 minutes time frame, 1 hour time frame, 4 hour time frame. You wait for the breakout. Wait for the breakout to get the direction of the market. Maybe after the market has consolidated in a symmetrical triangle form, you wait for a breakout. Then if you have to buy, if it breaks out from the from the from the top, you buy. If it breaks out from the downside, you sell. You really don't need to master any form of or check for any form of direction and all of that stuff to not get yourself confused. You just wait for the breakout, right? And we can call it symmetrical triangles, or you can call it two converging trend lines. Two converging trend lines, in the sense that you might have a market that has been going like this. Markets have been going like this, right? This is the overall trend of the market. And at this point, the market starts creating something like this, 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 right? Then the market is coming from this top. It's coming from this top, right? Then you have something like this from here. You have something like this from here. If you look closely, a symmetrical triangle has been formed. I don't know if I arrange this well. A symmetrical triangle has been formed. Two converging trend lines. If the market breaks out from here, you start buying. Ignore this whole this. Then if the market decides to break out from here, it means this strong bullish trend line has been broken. And you know what? It starts also selling immediately, right? So basically this is how this works. Then the second we have double bottom, double bottom, double bottom, double top. I'm looking for this text. Let's short. I don't know. Let's have it here. Double bottom, double bottom. This is a double bottom chart pattern. Double bottom or equal eyes. If you can't call it double bottom, you can call it equal eyes. But there are cases where the eyes are not equal. There are cases where the eyes are not equal. But we won't be talking about that. We're just going to be going majorly into equal eyes, double bottom. Sorry, I'm going. This is actually double top. Sorry, I'm making a mistake. Sorry, please. This is a double bottom. So sorry about that. This is a double bottom type of type of chart pattern. This is it here. Sorry, guys. Sorry for that mistake. I apologize. This I was distracted actually. This is a double bottom. Equal lows, I meant to say. Equal lows create a double bottom. A double bottom is formed or can be found at sub at demand zones, right? Demand zones. You find double bottom at demand zones, resistance zones on your what's it called? You know, what do these SMC traders call it? I don't know. But you find them majorly on demand zones, right? When the market has been coming, creating series of highs, lows, highs, oh shit, highs and lows, lows, high, and it approaches this place, right? Then it gives you something like this, double bottom. This is a very, very strong confirmation for you to know that price is respecting this demand zone and it's time for you to watch that buy, right? It's like a trend reversal chart pattern, like it changes the trend of the market. If the market has been bearish coming into a demand zone and it gives something like a double bottom chart pattern, you wait for a breakout from the neckline before you start buying. This is what we call the neckline. This point is called the neckline, right? It breaks out of the neckline, gives a clear retest, and boom, you can start buying off that demand zone as easy as that. Or whereas let's say, okay, let's not say a demand zone, the market is not buying into a demand zone this time around. There's no demand zone below. The market is just, let's say, oh, why am I cloning this? Let's say the market is just selling, like selling, putting lower highs, lower lows, lower highs, lower lows, lower highs, and it just gives you something like this, this, and this, breaks out of this. The moment it breaks out of this neckline, you wait for a retest. Then from here, you do what? You start buying, right? Because why? It has created what? Equal low, double bottom. You buy immediately it breaks out and retest where the neckline. You see, as easy as that, right? Then we have the third one, which is the opposite of the double bottom. The opposite of the double bottom, we have the double top. We have the double top. I don't want to make this video lengthy, right? Double top. You also find this on your supply zone when the market has been, bullish, bullish, bullish market. Have a bullish market. I'm not double tapping this thing. Bullish market, and comes here, creates equal high, breaks out of the neckline, retest it a little bit, and you have this double what? Double top. So we're just going to dive straight into live chart examples. I don't want to bore you guys with I don't really want to bore you guys. Let's just go straight into the charts, right? Where's my charts? Okay. Look at the symmetrical triangle. The market has been bearish. If you notice the symmetrical triangle, price consolidated around the symmetrical triangle. You see that? You see what price did around here? Did, did, and it broke out. No clear retest, it broke out. It broke out, gave a retest with one candlestick. Just one candlestick gave this retest. And immediately it started selling, right? But majority of the times, the market does not retest. So what you ought to do is you enter from the candlestick closing below the breakout candlestick. This is the breakout candlestick. You enter from the breakout candle, the closing, right? It's always a bearish candlestick. A bearish candlestick always breaks out if it is to sell. If it is to buy, it's always a bullish candlestick breaking out. So you enter from the closing of the bearish candlestick if it is selling. If it is to sell, you enter, you put your stop loss just right above the previous high. Then you target 1 to 2, and boom, here you go. Expected. So at this point, if the market decides to make a very very clear retest, you won't still get stopped out. Why? Because your stop loss has been placed above where the previous high, of which market is not going back to that level. I hope this is clear and understandable, right? Then we have, look at this also, double top, right? You see what the market did. Market has been bearish. It has been bearish. It just came down like this and gave us something like this. Did this, did this, did this, and did this. At this point, it's already here. You wait first of all for the breakout, and immediately it breaks out from here. It just breaks out to the bearish candlestick. You sell, sorry. You enter your short position from the closing of the breakout. Then you put your stop loss below any previous high that has been formed. This is an high that was previously formed. So you can put your stop loss here and do what? And target 2RR. We have 21 pips stop loss. We'll be targeting 40 pips. Take profit. You understand me? So what I'm saying is, so at this point, if the market also decides to give a retest to the neckline, you won't still get stopped out. It's for your own safety. So that is why these chart patterns are powerful. You can enter immediately after the breakout without getting stopped out. You can enter immediately after the breakout without getting stopped out, right? That is why I call them powerful chart patterns. enter without even after the breakout. Don't wait for a reset. You won't still get stopped out. Same thing applies for double bottom. I don't want to go much into details and bore you guys, but that's just it. This is what I have for you guys today. Have a nice day. Enjoy yourselves and make money. Thank you.